What's up, guys? Welcome to the Cash Craft, your daily dose of finance and technology news and updates. Jamie Dimon just stopped buying stocks. The man who runs America's largest bank, who manages $3.9 trillion in assets, is sitting on the sidelines right now. This isn't some random hedge fund manager making a contrarian bet. This is the CEO of JP Morgan Chase, someone with access to more economic data than almost anyone on the planet, saying the risks in this market are bigger than what other people see. And he's putting his money where his mouth is. Here's what most investors are missing right now. The stock market just hit record highs. The S&P 500 is up. Tech stocks are soaring. Everyone's portfolio looks great on paper. But Dimon's looking at something else entirely. In a recent interview, he laid it out plainly. He's not buying stocks at current levels, not because he's panicking, but because the math doesn't work for him anymore. He sees risks that the market isn't pricing in. And when you dig into what he's actually worried about, it's not just one thing, it's a convergence. Start with inflation. Most people think we've beaten it. The headlines say it's cooling, but Dimon's not convinced. He's watching the underlying pressure points: government spending that hasn't slowed down, geopolitical tensions that keep energy prices volatile, and a labor market that's still tight enough to push wages higher. Any one of these could reignite inflation. All three together, that's a different risk profile entirely. Then there's the interest rate environment. The Federal Reserve has held rates higher for longer than almost anyone predicted 2 years ago. And here's what matters. Those higher rates haven't broken anything yet, but they're sitting in the system like a delayed fuse. Commercial real estate is struggling. Regional banks are still dealing with unrealized losses on their bond portfolios. Small businesses are refinancing debt at rates they haven't seen in 15 years. But here's where it gets interesting. Dimon isn't just worried about what's happening. He's worried about what the market expects to happen next. Wall Street is pricing in rate cuts, multiple rate cuts. The market is betting that the Fed will pivot, that everything will get easier, that will return to the low-rate environment that fueled the bull market for over a decade. Dimon's not buying it. And if he's right, if rates stay elevated longer than expected, or if inflation comes back and forces the Fed to hold steady, then stock valuations that look reasonable today suddenly look expensive, really expensive. Now pay attention to this next part. When the CEO of JP Morgan says he's not buying stocks, he's not saying sell everything and hide in a bunker. He's saying the risk-reward ratio has shifted. At these valuations, with these uncertainties, the potential downside outweighs the potential upside for him personally. This is someone who lived through 2008, who saw the financial crisis unfold from the inside, who understands how quickly confidence can evaporate when the fundamentals don't support the prices. He's not predicting a crash, he's saying the margin of safety has disappeared. What most people don't realize is that market risk isn't just about what happens. It's about what happens relative to what everyone expects. Right now, the market expects a soft landing. It expects inflation to stay controlled. It expects rate cuts. It expects corporate earnings to keep growing. That's a lot of things that have to go right. Dimon's looking at all the ways they could go wrong, and he's seeing more downside scenarios than the market is pricing in. That's what he means when he says the risks are bigger than other people think. It's not that disaster is certain, it's that the probability distribution is skewed more negatively than current prices reflect. Here's the thing nobody's talking about. When someone like Dimon makes a statement like this, it's not just personal investment advice, it's a signal. He's telling you what the smartest money in traditional finance is thinking right now. And the smartest money is cautious. The question you should be asking yourself is this: if the person with the best view of the financial system thinks the risk-reward is off, what does that mean for your own portfolio? Are you positioned for what the market expects, or are you positioned for what could actually happen? Personally, I'm still holding my core positions, but I'm not adding aggressively at these levels. When someone who's seen every market cycle since the 1980s is tapping the brakes, that's information worth paying attention to. That's all for today, folks. If you found this helpful, make sure to like and subscribe to the Cash Craft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.